All right, some of my late night thoughts about the budget, literally sitting here in my pajamas near the fireplace, trying to absorb some of this stuff. I'm actually pretty excited by the whole thing. They've changed the landscape, which means that we need to change the solutions. For our traditional business, which has always sold brand new property, this has been a positive. Negative gearing still applies to brand new property. And what I didn't expect was there to be a CGT exemption, a capital gains tax exemption from the new changes, which means that we still get, if you buy a brand new property moving forward, a 50% capital gains tax discount. So that was a nice little bonus particularly for lots of our clients who are buying. If they've bought before, anyone who's bought before, your portfolio has been grandfathered. What does that mean? It means that the negative gearing doesn't get impacted by any of the changes. You can still negatively gear as you did before. In terms of capital gains tax, this one's an interesting one. So in terms of the grandfathering, so any of you who own investment property already, your capital gains tax discount will apply all the way through to the end of the next financial year, June 30, 2027, as far as I understand it. At which point we will have to value our properties on that date and then moving forward, apply the new capital gains tax system. From what I understand is a choice between a 30% and an indexation. But basically, if you buy $1 million property and inflation means that the property is worth 1.3 and then you sold it for 1.5, you pay tax on the 200. Now, for those of us or those clients or those of you who still want to find opportunities in the existing property market where the property is already in place, it's not brand new, and therefore negative gearing doesn't apply, what that means is that you will now need to get a higher yield. Now, rents are going to rise across the board because these changes will reduce supply, as they have done every time and in any country where they remove negative gearing. So rents will rise. If you're a renter, get prepared for it. If you're an investor, prepare for that as well. And the winners will be our clients who have already got investment properties, and their rents will rise over the next 6 months, 12 months, 18 months. But if you want to buy a pre-existing property, you will now need to consider the rent, right, the rental return, the yield, and where the balancing point is in terms of your affordability. So remember that if you bought a property that wasn't brand new, since 2017, you haven't been able to depreciate the fixtures and fittings in the building inside the property. And of course, your depreciation on the building itself is reduced because there's 40 years of it, and maybe you've already used 10 or 15 or 20 years of it, and it was at the price of the construction when it was built. So the depreciation was significantly lower anyway. So the calculation that we need to run now is, of course, the negative gearing that you were getting, for example, on the bank interest payments, and of course the costs, property management fees, insurances, etc. How much more rent do I need to get to cover those costs so that I end up in the same position as I was in if there was negative gearing? So now that becomes really important, and they are some of the things that will factor into cash flows moving forward. Now, the reason I'm excited by all of this is because what environments like this is they produce a plethora of opportunity. There are opportunities out there every day, and we need to take advantage of them, we need to find them, and we need to make sure we execute on them. Now, one bunch of our clients who will not be affected by this are those who earn an income outside of Australia. So lots of Aussie expats around the world who are Blue Wealth clients who buy property in Australia, whether existing property or brand new property. This will not affect them. The negative gearing component of it will not affect them at all. Obviously, the capital gains changes will. They may choose to move towards a new property rather than a mix of both. But for those people that are earning an income outside of Australia, this will have less of an impact on them than for those of us who are earning an income inside Australia. Another opportunity that we've been looking at and have looked at over the years many times is property in other parts of the world where Australian tax laws don't necessarily apply. Can I find a property in another part of the world that will grow and will rent well, enhancing my opportunity to build some wealth? So some of those opportunities are currently being explored. They were being explored before this budget. They will continue to be explored. Our job essentially is to find solutions for our client to create wealth through property. Now, I've always preferred buying property in Australia. Many of you, those of you who know me well, know I have a lot of property all around the country. I bought one property every year for 24 years at least. So I love Australia, I understand it, I know it, but that doesn't mean that we shouldn't be looking outside of these geographic boundaries. So one of my rules in life and in business is don't panic. Never, ever panic. Just stay calm, because your brain thinks clearer and more effectively when you stay calm. If you are concerned about it, reach out to us. We can have a conversation about it. All right, the pajama series continues. So I didn't get much sleep last night because I've been thinking about the implications of this budget. But one thing I can tell you is that all of the clients that we've been able to help, most of the clients that we've been able to help in the buyer's agency service that we started 18 months ago, as a result of the increase in construction costs on new property and the elevated entry price. You know, to get into a new property, you sort of need 650, 700 grand. A lot of people can't afford to do that. So you might have a young investor who's in their early 30s or late 20s or whatever who wants to buy a property but can't afford to buy in the place where they live. So we've been able to find them a property somewhere around the country. They continue to rent and they're rent vesting. And the only way they can get into the market at their price point, 500, 550 maybe, is to buy a property in another part of the country, and therefore it's in their affordability band. Now that's dead. So all of these young people that potentially could have been rent vesting, now they'll have to buy new properties, so they need to be able to afford it. So one of the implications of all of this, just straight off the bat, is this intergenerational wealth rubbish that they're going on about, wealth distribution. They've essentially taken away a strategy that multiple generations have used to build wealth for their families, as I have for my own family and many of my staff and obviously thousands of our clients. We've been supporting the children of our clients. That's how long I've been around, who bought from us 10, 15, 20 years ago. Now they're coming and wanting to buy property. And if they can't afford to buy a new property, we're still able to help them. Well, now we need to find a different way. I'm not going to say we're not going to be able to help them. I will find a way. But immediately they've removed the biggest opportunity that young people have to get into the market. All right, not in my pajamas this time, in my Bulldogs Las Vegas t-shirt. Going to Magic Round tonight for the weekend with my sons and my nephews and some friends. Pretty excited. It's been a big week. Just wanted to have a quick chat about the current generation. One of the other things that this government has confused itself about is what young people actually want. And I know more than they know because I deal with these young people who want to get into the property market. And a lot of them don't want to buy a property. They don't want to buy a home. They're happy to rent invest. They can't afford to buy a home in the suburb they actually want to live in. These days, lifestyle is a priority over what used to be the great Australian dream. And so what this removing negative gearing has done, it's affected the people that can't afford to borrow enough to buy a property that they can live in, even in a suburb they don't want to live in. So they've just made the assumption that the current generation thinks like past generations. And I can tell you that they absolutely do not. They approach life differently. They know they need to think differently. How many young Australians around the country in places like Sydney, like Brisbane, like Perth, and Adelaide that have been absolutely exploding over the last few years, how many of them can afford to buy in the suburb they actually want to live in? Now, some of you might argue, well, they shouldn't, this young generation has to suck it up, go and live in a suburb you don't want to live in. But you know what? They don't want to do that. And that is their choice. So from my perspective, it's another way that the government has negatively impacted the exact people they're trying to help. And some people can't afford to buy a new property. You say, let them, they can buy a new property. Well, some of them can't afford to buy a new property. They've missed the mark.